Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis on Friday, November 21, 2014. You're looking at a daily chart of the SPY, and quite an interesting day. So I've been mentioning in these videos that with the Bank of Japan coming to the window with their own version of additional quantitative easing in Japan after our own Federal Reserve stopped our quantitative easing here in the U.S., I said that the ECB in Europe, the central bank in Europe, was going to be next. And this morning, we got a glimpse they're going to be next. They are next. They're starting to buy asset-backed securities, and they're probably going to buy other stuff moving forward. And what that did was, early in the morning, when that announcement came about, that definitely propelled the market upward. And we had a decent day upward, but I just wanted to talk about some of the cracks in the armor as we go along here. But all in all, the S&P was up 0.5%, the Dow was up 0.5%, and the NASDAQ was up only 0.25%. Now, what happened was, while it looks like a decent day, the index was up a whole lot more. So let me go to the intraday chart of the SPY, and now you can see what I'm talking about. Here's first thing in the morning, right? We gap way up, okay? We went from a close yesterday of 205.59 in the spider, right? SPY. And we opened up today, okay? Today we open at 207.64, all right? So basically call it 20 points, or 2 points in the SPY or 20 points in the S&P. Okay, that's a big move. All right, that's basically double where we finished. But look what happened. So we opened up, and that was basically the first minute of the day was the high of the day, and we just sold off for the remainder of the day. A little bit of choppy in the afternoon, a couple of bounces along the way, little bit of a buy program into the close like we usually see, especially on a Friday. But I'm not taking anything away from the market. It was an up day, and I get it. But, you can't buy the market up here for those reasons. Anybody who chased the market this morning is losing money, right? Because if you bought the market right on the open and figure it was just going to keep going higher, you basically were down for the day. And this is what we call, now, it would have been a true gap and crap if we finished down on the day, but this is close to a gap and crap. We gapped up, and then we basically crapped out. And what that tells you is really that the market is exhausted from this move. There's not a lot of upside left in this move. That's not to say that we won't see more upside into 2015. In fact, I'm here to tell you that as things look right now, I would say that the market has between 5 and 10% on the upside throughout the first quarter of 2015, maybe slightly beyond, but that's as far as I can see right now. I can see the S&P reaching 2150, maybe even 2200 2150, 2200 into the first quarter of next year. But you're going to have to see a pullback first. And we'll go to the daily chart, as we always do. Oh, that's not the daily chart, all right? And, basically, we're still going to have a pullback. And, our pullback's going to come somewhere in this neighborhood. In fact, if we don't get much of a pullback, a good level would be this pivot high here. And this is going to lend some support. We may or may not go below this level at this point. We'll see what happens. And like I told you last night, we're going to look for a lot of sideways movement, light volume, probably a float higher for a couple days next week, maybe even early in the week, and then basically the volume's going to dry up, and there's not going to be much movement in the market next week because it's Thanksgiving. So we'll see a pullback eventually. We'll probably see it maybe the week after. And then after the pullback, takes hold and we consolidate for a week or so, we'll probably go up for the Santa Claus rally and then into New Year's. And then I'm looking for higher prices into next year, but not before a pullback. So you can't buy the market up here because it's almost like a fool's game. Now, the market can go higher and it may go higher, but if it does go higher, I'm not going to buy the market without a pullback. Put it that way. It's just the risk now is on the downside. And as a trader or as an investor, you have to look at where your risk reward is. So if we're buying the market up here, okay, what's the likelihood that we shoot up higher, or is it easier to fall down from here after all this move, right? You had this parabolic move all the way up with hardly one down day. I don't even count these. These are basically flat days. This is not a down day. It's just down from where we opened. So we had one down day in, I think this is like 25 trading sessions. So maybe 24 or something like that. It's just ridiculous. So, I'd rather sit on the sidelines as a spectator and have my cash in my pocket rather than buy the market up here and take the risk that I'm going to buy it the day before a pullback. Okay, so I'm not going to do that, and I don't recommend anybody do that. If the market goes without you, it goes without you. There are some individual stocks that you can certainly buy. Put out a trade alert to members yesterday, and it's doing okay. It was up nicely today, a little bit higher throughout the day than it finished, but so far so good. The issue is up a little over 2% from the issue price, and that's pretty good for a one-day move. So we'll stick with that one, and we'll play it by ear. If I see another setup, I'll issue it to the subscribers, and we'll go from there. So a couple other things I want to look at, just some more evidence. Let's look at the IWM, which we love to do. And I'm going to look at the intraday chart of the IWM. Okay, same thing. Up high at the beginning of the day, okay? We closed yesterday at 116.44. We opened today at 118.08. Okay, that's a huge move in the IWM. And then what did we do? We basically crapped out. So what that's telling you is that the market is exhausted, and we just do need a pullback, and that's basically the bottom line. I'm sticking to that story. All right, so let's go over to the gold market. And gold was almost the same routine today. Gold was up overnight, early in the day, and then we basically sold off today. However, if we look at a longer-term picture of gold, and let's go to a daily chart, and then I'm going to even go longer than that. This is okay. I mean, we're chopping around, but we're kind of edging higher, and we came in just almost to the 50-period moving average, which is this blue line here today, and then we pulled off of it, which is okay. But there's higher prices coming, and here's the deal. Okay, with the Japan Central Bank printing money, and now the European Bank printing money, the ECB, okay, buying assets, okay, they're trying to cause inflation, okay? That's going to cause people to buy gold. That is causing people to buy gold. What you saw here when this bottomed out and it started up, you saw the anticipation of inflation. And that's what's happening. Okay, so we're going to see higher prices in gold, but you're not going to see a straight line. Okay, gold's going to move up, it's going to move down. It's going to move up, it's going to move down. But all in all, where did we finish the day in gold? We finished the day at 1201.50. That's a pretty strong close. The fact that we closed over 1200 is positive, and it does portend higher prices. We can back and fill a little bit, but you're going to look for in the neighborhood of about 1230 to 1240 in the price of gold futures. And what that means in the price of GLD, how does that translate to GLD? Usually it's about 10%. GLD is about 10% of the price of spot gold. So you can look for, on this move, okay, and I don't mean that's the top end of gold. I just mean on this move before we have any kind of a significant pullback, you're going to look for about $4, $4.50, maybe even $5. So what does that take us to? It takes us right to about this pivot high, 120. So it makes sense. So this pivot high is going to be definitely a stopping point for gold. It's probably going to have to consolidate after it reaches this pivot high, but that's a pretty good move. If you can get $4 or $5 out of the price of gold, a lot of us will take that trade. So you can be long gold here, you can buy on weakness, and you can basically use, in my mind, you can use a stop out on close below 113.68 if you want to play it that way, or you can just hold it. You can accumulate gold in this area here. And you're going to see some backing and filling, but you're going to see higher prices in gold. Let's go over to oil. And here's the USO. And oil had a wild ride today. It was up, it was down, it was up, it was down, it was up. And we hit the level I talked about over the last several days. We actually surpassed it a little bit. I think we got as high as about 78 today and change. Maybe was it even higher than that? Let me see. I'm looking at the crude. I'm looking at the January contract on my other chart here. Just give me a second. Get you the number. It's only fair. Okay. So we basically came to about 77, 79, which is right into the 20-period moving average. The exact number is 77.83. Okay, so we pierced the 20-period moving average slightly and then backed off, finished at 76.51. And, maybe 74 in the price of crude was a good low. There's still a 72 number I've been talking about out there. I'm not sure we'll get there or not, but if not, we can certainly have higher prices. But we have to get through 28.98, we'll call it 28.98 on a closing basis, a daily closing basis. We have to get through that level in order to see higher prices. And then your next target would be this 20-period moving average here, which currently is at 29.61. Okay, and as the price of crude oil moves up, as does the price of a lot of the energy complex, the MLPs, the integrated oils, Exxon, Chevron, Conoco. You see a lot of the midstreams and a lot of, all kinds of oil producers. Everything kind of inflates. And that's what's going on. You can see it with the central banks inflating. You can see that the commodities are starting to inflate again. Gold is inflating. Oil's inflating. Stocks are inflating. And that's what the central banks want to do. They want to cause inflation because it's the only way that they believe they can get out of this economic mess that we're in. Now, mind you, this will end badly, but it's not going to end badly anytime soon. Nothing that you have to worry about anytime soon. I'll let you know, but you're probably at least a year away or two from it ending really badly, maybe even longer than that. There'll be pullbacks and there'll be severe corrections along the way, but I'll let you know about those too. But when it really ends badly, Japan's going to be the one to fall. Japan's going to unravel like a spool of thread because their GDP, their debt to GDP ratio, I believe, is about 300 to 1. That's 300% debt to GDP. That's unsustainable, and there's really no way that they can grow out of that. They convince themselves that they can. They pretend they can, as does the ECB, as does the Federal Reserve in the U.S. They all pretend that they can grow their way out of this debt problem. We have $17 trillion worth of debt and a $500 billion annual deficit. That's unsustainable, folks. There comes a day of reckoning when people just won't lend money anymore under those conditions. And when bond prices fall and interest rates move higher, we won't be able to borrow money and pay off the debt. It just won't happen, but that's a ways away. They're going to keep rates low as long as they can. Even if the Fed raises rates next year, they're going to raise them 25 to 50 basis points on the overnight Fed funds lending rate. That's nothing. It's nonsense. The market will sell off on the anticipation of that, but in reality, that's not going to impact anything in real time. It'll just be the anticipation of rates going higher that will cause the market to falter. But all in all, that's not going to be the deciding factor. I just want to show you another thing that's a little bit interesting that I noticed today. And, let me show you two things. Here's Alibaba. I want to look at an intraday chart of Alibaba. Now, the market was up, and this is one of the strong players. This is one of the new momentum stocks, and you had the same thing. You had a gap and crap. And when the momentum stocks that all the hedge funds and all the institutions are owning and buying and playing, okay, and all the traders, you would think that this stock would have gone up and remained up today, and it didn't. So, again, it's just more evidence that the market's getting tired. One more thing I want to show you, which I think is very interesting, is, and this is how the charts tell you what's going on. This is Google, right? And here's a daily chart of Google. Now, if you look at this, okay, the Google bottoms out like when the market bottomed out, right? In the middle of October, and we rallied up. We came nowhere near a new high like the market did, not even close. Basically, all we did was a 50% retracement from this move to this move. Now look, high, lower high, lower high, okay? We never made it up even to this pivot high. We just crapped out. And what happens is the charts tell you something's going on. Now, you don't necessarily know what it is, and frankly, you don't really care what it is, but you knew that Google, or you should know, that Google was in some kind of trouble. And then today, I saw why. I saw an article that the European Union, the EU, is talking about they want a breakup of Google because they have too much of a stronghold in internet search. Now, I don't know if anything will come of that or not. It doesn't really matter right now. It's very similar to when Microsoft was going through the same routine and they wanted to break up Microsoft because they basically had a monopoly in the operating system market for PCs. And what happens is the charts tell you that there's something going on. So what happens is when Google's selling off and the market's going higher, there's something wrong. Now, Google, let's look at the NASDAQ market. Here's the Qs, okay? Now, here's October low. We rally up, make new highs, okay? That's the NASDAQ. Google, we rally up, crap out, and sell off. Something was telling you there's a problem. Today, the problem was uncovered. Did anybody know that was coming? I have no idea. I don't really give a hoot what the news is. The charts tell you what's going on. It tells you what stocks are strong or markets are strong, and it tells you what's weak. And in this particular case, this is a perfect example of the charts telling you something was wrong with Google. All right. I don't know what's going to come of it. I don't care what's going to come of it. We just let the charts tell us what to do. With that being said, folks, have a great weekend. I'm David Frost, mystrategicforecast.com. This was another episode of Common Sense Market Analysis. Thanks for tuning in.